Imagine this scenario. A company reports record revenue, significant year-over-year growth, meets analyst expectations, sales, earnings per share, the works. Sounds like a clear win, right? By all accounts. But then, bam, its stock price just plummets 14, maybe 16% within hours. What in the world happened there? How do you get such a dramatic reversal?
It really is the kind of market reaction that makes you scratch your head, isn't it?
Totally.
And these kinds of, well, seemingly contradictory outcomes are exactly why we need to dig deeper, look beyond just those top-line numbers.
Absolutely. So today we're taking a deep dive into Marvell Technology, specifically their recent Q2 fiscal year 2026 earnings. We'll look at that surprising market reaction and what their guidance might reveal about the future of AI chip demand.
Yeah, there's a lot to unpack there.
Right. We've pulled together insights from their earnings call transcript itself, less analysis from investing.com, 247 Wallsaint, Benzinga, the Cryptonomist, and A-Invest. Our mission.
Unpack this paradox, understand the market's why, and, extract the most important insights for you, the curious learner, about what this signals for the broader semiconductor and AI landscape. Okay, so let's unpack those headline numbers first. Marvell reported some, well, pretty robust Q2 figures for fiscal 26.
They really did on this.
Revenue hit $2.006 billion. It's a big jump, 58% increase year over year, 6% quarter over quarter. And crucially, that was right in line with market forecasts. Then there's the non-GAAP earnings per share, EPS. That's a key measure, right? Profitability per share, excluding certain one-off items.
Yeah, very key metric.
It also reached a record, 67 cents, up an impressive 123% year over year. Again, bang on expectations. So look, on paper, fantastic quarter.
But what's truly intriguing here is that despite these strong headline figures, the market reaction was, well, anything but celebratory.
Right. Initially, the stock actually saw a little bump, modest, maybe 3.26% in aftermarket trading. Showed some initial positive feeling.
Okay, so it started okay.
It did. But then, as the earnings call unfolded, and crucially, as they released their forward-looking guidance, confidence just eroded rapidly.
Oh boy.
The stock was down 7%, then 10%, eventually 13% after the call, and then it really crashed. Friday morning trading saw it down 14 to 16%. It closed down almost 17%, 16.79% to be exact, at $64.26. So it really raises that pivotal question, why such a sharp reversal?
Yeah.
Record results, meeting expectations. What gives?
Okay, so if the Q2 numbers themselves were strong, met the targets, what shifted investor sentiment so dramatically? Where was Wall Street really looking for those, future signals? And what did they find, or maybe not find, that spooked them so badly?
Well, the core of the disappointment, it really appears to be Marvell's Q3 guidance.
The forecast.
Exactly. Imagine getting like an A on a test where everyone, absolutely everyone, expected an A+. That's kind of how Wall Street reacted.
Ah, okay. The expectations game.
Precisely. While Marvell's forecast of $2.060 billion in revenue for Q3, technically it was in line with some analyst estimates. But crucially, it fell below what many others had projected. They were looking closer to $2.104 billion.
So a slight miss versus the higher end of expectation.
A slight miss, yeah. But in this market, especially for AI-related stocks, that perceived miss on the growth trajectory. It signaled a cautious outlook that really spooked investors. It was almost like they'd been handed a surprise pop quiz they weren't ready for. Wall Street wasn't just looking for meeting expectations.
Ew, not an AI.
Not an AI. They wanted them to exceed them. Given the whole hypergrowth narrative, they were intensely scrutinizing Marvell's custom AI silicon programs, their HBM integration. That's high bandwidth memory, crucial for AI chips.
Right, the fast memory.
Their co-packaged optics, which is about merging optical and electrical bits right on the chip for faster data.
Cutting edge stuff.
And just generally the scale up of their big custom client relationships, those hyperscalers. These are the future growth engines everyone's watching so closely.
Got it. So that slight miss on Q3 guidance, particularly relative to the higher hopes, became the focal point. And digging deeper, where exactly did that confidence waver most? You mentioned segments. I assume it's tied to their biggest one, data center.
Precisely. That's the strategic heartland. While data center revenue surged, an impressive 69% year over year to $1.490 billion in Q2.
Still huge growth.
Huge growth. But it slightly missed Wall Street's higher expectations. They wanted maybe $1.520 billion for that specific segment. The real concern, though, was the Q3 forecast for data centers. It's expected to remain flat.
Sequentially.
Flat after 69% year over year.
Flat quarter over quarter. That's a significant perceived slowdown after such rapid growth, especially with the AI narrative pushing everything higher. That word flat really stood out.
Flat sequentially in data center with AI booming, yeah, that definitely sounds like hitting a speed bump. And this is where the CEO, Matt Murphy, introduced that phrase, right? Lumpiness, to describe the custom silicon business. Yes, and this brings us to a really key point in their commentary. Murphy explained this lumpiness as basically a normal thing for these huge hyperscale buildouts.
Hyperscalers being the Googles, Amazons, Microsofts, the giants building massive data centers.
Exactly. He described it as a one-quarter digestion, like they just need a brief pause. With a strong recovery anticipated in Q4, he explicitly stated that while custom revenue would be lower in Q3, it would be substantially stronger in Q4, and that the overall custom business would still be up in the second half of their fiscal year compared to the first half. So from his perspective, it's cyclical, a temporary pause, not some fundamental problem.
Okay, so the CEO calls it lumpiness, frames it as a temporary digestion, strong recovery coming soon. But let's be honest, that can sound a little convenient, maybe. What were investors really worried about? What made them doubt this cyclical view enough to send the stock tumbling?
That really is the million-dollar question, isn't it? And our deep dive into the sources suggests why investors remain skeptical. It wasn't just the lumpiness comment itself. There seem to be several underlying factors that maybe complicated Marvell's optimistic forecast. And these challenges, they aren't just Marvell's issue. They kind of illustrate the brutal, unpredictable reality in this hyper-competitive AI chip market. What this reveals for you is that even market leaders face immense pressure. Potential isn't enough. You need concrete, flawless execution.
Okay, so what are these factors?
Well, a few things seem to be swirling around. First, project delays. Reports suggest Microsoft might have postponed the launch of its internal AI chips, the Maya project, until at least fiscal 2028.
Oof. A delay from a major client like Microsoft is never good news. That's a big red flag.
Definitely. Second, competitive pressures. Marvell's ramp-up for Amazon's Trainium program has reportedly been disappointing, with a competitor, Alchip, apparently gaining some share there. Highlights the fierce competition.
So losing ground, potentially, on a key project.
Potentially. Third, possible technical setbacks. There are suggestions, whispers maybe, that Marvell's SerDes technology, that's the serializer tech, vital for high-speed data transfer in chips.
The data superhighway inside the chip.
Exactly. That it might have faced some performance issues, which could potentially strain client relationships if true.
Technical hiccups are always a concern in this field.
Always. And fourth, just the broader trend of multi-vendor strategies. Hyperscale customers, these big giants, they're increasingly using multiple suppliers. Diversifying.
Hedging your bets.
Right. Reduces their risk, increases their leverage, but it naturally adds competitive pressure for Marvell and everyone else to constantly win and keep that business.
So yeah, those are definitely real headwinds. Paints a picture of a tough, dynamic market out there. But Marvell isn't just sitting idle, presumably. The company did highlight significant long-term potential, like 18 multi-generational custom XPU and XPU attached sockets. Those are specialized processing units.
Right, for AI and other tasks.
Yeah, it's already in the pipeline. And over 50 new opportunities, they say, represent an estimated $75 billion in lifetime revenue potential. That's a huge number. But as you said, the market seems to be in a prove-it mode now, demanding concrete revenue, not just potential future earnings.
Exactly. The potential is clearly there. They have the design wins, but the market is saying, show me the money, show me consistent execution now. It's that classic show me state.
Okay, it's important, though, to remember, it's not all headwinds. Even with these challenges, where is Marvell still shining? What are the bright spots? And what strategic moves are they making to position themselves better for the long haul?
Yeah, absolutely. Their electro-optics interconnect portfolio is a clear bright spot. Really strong. It's projected to grow double digits sequentially in Q3.
Okay, so strong growth there. Why is that so important?
Well, this isn't just any growth. It's in a critical strategic area. This segment is fueled by strong demand for things like 800 gig PAM DSPs.
The advanced signal processors for high-speed data?
It's exactly. Vital for data centers. Plus, volume shipments of their next-gen 1.6 terabit PAM DSPs. And just general leadership in next-gen optical tech, like their 400 gig per lane stuff. These components are essentially the backbone of modern AI infrastructure. They enable the faster, more efficient data flow that AI absolutely demands. It's a space where, frankly, few competitors can really keep up. So this performance really showcases Marvell's core engineering strength in high-speed connectivity.
That makes sense. High-speed interconnect is fundamental for AI. And you mentioned strategic moves. A big one was selling off their automotive business, right?
You're right, that was significant. A $2.5 billion all-cash deal for their automotive Ethernet business, and they completed it ahead of schedule, which is always a good sign.
Why sell that off?
The company was very explicit. They said it aligns with their strategy to redirect investments. Where? Towards the massive AI opportunity in data centers. They're going all in on AI.
Doubling down.
Absolutely. The cash gives them flexibility, too.
Mhm.
For ongoing stock buybacks, they still have $2 billion authorized there, and for generally bolstering their technology platform. And starting Q3 of fiscal 26, they're even streamlining their financial reporting. Just two categories, data center and communications and other. It really cements their new identity as an AI-focused company. A clear, uncompromising focus.
Okay, so they're divesting non-core assets to double down on AI, but what about their other foundational businesses? Are they just being neglected, or is there maybe a quiet recovery happening elsewhere that investors might be overlooking amid the data center drama?
That's a perceptive question, actually. It is worth noting the recovery in their, let's call them core business segments outside of data centers, things that had been a bit weak before.
Like what?
Enterprise networking and carrier infrastructure, combined, those saw a 43% year-over-year increase in Q2.
Yeah.
And they're expected to grow approximately 30% sequentially in Q3.
Wow, okay, so a strong rebound there.
Yeah, it marks a really strong recovery. They were down at a low point, maybe a $900 million annualized run rate back in fiscal 2025. Now, the Q3 forecast implies something closer to $1.7 billion annualized. Their long-term target is $2 billion annual revenue there. So it indicates a broader, more diversified rebound happening sort of quietly in the background, which is definitely a positive sign for overall stability.
Good point. And to support this intensified focus, especially on data center and AI, Marvell also announced some leadership changes.
Yes, significant ones. They promoted Chris Koopmans to president and COO, and Sandeep Parathi to president of the data center group. This move essentially unifies full ownership of their largest, most important business, that data center segment, under a single leader. It really reflects their commitment to accelerating growth and execution in that absolutely critical area, trying to ensure perhaps no more lumpy surprises.
Okay, let's recap. Marvell delivered strong Q2 results, met expectations, yet faced a significant stock drop. Why? Cautious Q3 guidance, particularly that flat forecast in its core data center business, fueled by underlying concerns about competition and execution. So, what does this whole deep dive reveal to you, the listener, about the broader landscape? AI infrastructure, semiconductor investing. What are the takeaways?
I think it really highlights the incredibly high expectations and, frankly, the intense scrutiny defining the AI chip market right now.
Sky-high bar.
Absolutely. Even robust growth isn't always enough if it doesn't significantly exceed an already elevated consensus. Blowout numbers are almost expected. And that lumpiness in custom silicon demand from the hyperscalers. It's a reminder that even these massive long-term trends like AI infrastructure can have short-term bumps, fluctuations. Customer investment cycles are not always smooth, linear, or predictable.
That's a crucial point. So, while CEO Murphy projects a Q4 recovery, maybe the market is right to be a bit skeptical, fearing this lumpiness might become a more permanent feature given how competitive it is. It's a powerful reminder, isn't it? The AI opportunity is undeniably massive, as Murphy said, but it's also intensely competitive. It requires continuous innovation, flawless execution, especially when your customer base is so concentrated, like with the hyperscalers.
Absolutely. And for you as an informed observer, it really underscores the importance of looking beyond just the immediate headline numbers. You have to. Digging into the guidance, understanding the segment-specific performance, recognizing those underlying strategic shifts, the competitive dynamics, that's all crucial for truly grasping a company's position in this market. It evolves so fast.
Yeah.
It's just a constant battle for mind share and market share, and every single quarter feels like a new proving ground.
Marvell's experience really serves as a compelling reminder then. In this hyper-competitive, fast-paced world of AI infrastructure, even strong performance can be met with real market skepticism, especially if future growth isn't perceived to be accelerating fast enough to match those sky-high expectations. It's like you're in a race where you constantly have to outrun the perception of slowing down, even if you're still moving fast.
Well said. And the fundamental question remains, doesn't it? Will Marvell's strategic pivot, their strong design win momentum, those long-term custom silicon projects, will they ultimately deliver on that massive opportunity they envision? Will they convince the market that this lumpiness was truly just a temporary blip?
Hmm.
Or will the short-term fluctuations and the intense competitive pressures continue to create turbulence for the company and for its investors?
Exactly. And here's a final provocative thought for you to consider as we wrap up this deep dive. As hyperscalers increasingly move towards developing their own custom silicon for AI needs, what does Marvell's prove it moment, this recent turbulence, what does it tell us about the future for all chip makers, especially those navigating this new era of bespoke custom AI hardware? Will we see more volatility like this, a consolidation of power among just a few players, or maybe, somehow, a more diversified market in the long run, something to think about?